Good morning and welcome to the R3 podcast. I'm delighted to be joined today by Rory Dillon, founder and managing director of Fletcher. Rory, thank you for joining us.
Thank you.
To begin, could you tell our listeners a little about yourself, your background and your experience in the private credit market?
So my background is I qualified as a chartered surveyor. I have worked in property for over 20 years, but I've also, during that time, been a fixed charge receiver. So I touch a lot of restructuring work, working directly for lenders or also with insolvency practitioners generally. In terms of the actual overall private credit element, this is a new phenomenon in terms of what it's actually called or described as at the moment, but really it's been around for quite a significant period of time. It's effectively dependent on how you want to define it, unregulated finance. And we really started to see that coming about probably after the sort of last financial recession, 2008-9. Obviously, the banks wanted to recapitalize. That was under the duress of the regulators. And so they did so. Basel III rules obviously came in. But that created a lot of space for new lenders to also emerge into the market. And because they were underserved, banks didn't want to sort of deal with some of the customers that now private credit actually go out to.
So let's start with a big question. The subject line of your email certainly caught my attention. Are we heading towards a credit crunch 2.0? How has the growth of private credit changed the landscape for insolvency practitioners and receivers? And what types of businesses and assets are most commonly financed through private credit today?
So that is a very big question. And obviously no one's got a crystal ball when it comes to those kinds of things. I think there is a lot of connected risk. The private credit markets are, ever expanding and becoming bigger. I can only really speak for the world that I work in, which is in the property sector, and how I see that being impacted by it. But I'm seeing that more and more on a sort of regular basis, that are businesses which I am surprised at the level of debt that they're able to obtain through private credit. I'm also surprised at the level of due diligence done by the lenders themselves, how they understand the loans. That's me seeing that in the actual property space. And I understand that, within the sort of wider AI and tech, there's huge amounts of investment going into that. I see in professional services, the BDCs, the business development companies, they're growing and trying to assemble lots of companies and putting them together. But the thing that's very interesting about it, and I used to work at Royal Bank Scotland, so I'd seen how a financial institution grades debt, understands customers, and there's a very different mentality, it would appear, when it comes to private credit. And I just would say now, not all private credit is the same. Obviously, there is good actors, there's bad actors, and there's some fraudulent actors in there as well. But some of the things that I've seen, some of the less good examples, if you will, there doesn't appear to be that same level of rigorous credit stewardship. Ordinarily, a bank is looking at what would my assets be worth if they were liquidated. They need to understand what the security value of those assets are. When it comes to private credit, they're more interested in how much cash can this business, property, whatever it is, throw off to service debt. They're usually cash flow projections. They are on businesses or assets that haven't actually proved themselves yet. And it is a highly risky element of lending to be involved with. So when I see that and I see it being done on, say, development loans and things like that, that's where I think there's perhaps issues with it. I also think one of the concerns that investors probably aren't really aware of is that when they invest into these funds, they're not liquid. They've typically got very sort of lumpy assets that sit behind them. They can't get in there and get their money back quickly, which is why you're seeing some of these funds at the moment being gated. They're not allowing investors to take their money back. So I wouldn't say we're racing towards, credit crunch 2, but I think there's certainly issues that are there. If you look at what the Bank of England is saying at the moment, I was with them a couple of weeks ago and we were discussing this at length. And what surprised me was how much they actually did know about this. But they are interested to hear from the likes of us, what we see on the ground and how that works in reality, but they're doing the sways analysis. This is now with the IMF. It's featuring now on the G20 agendas. And the reason that it's featuring on all of this is because of the size of it, because it's levered. And so there's a hell of a lot of debt that goes into this as well, which to juice up these returns. But consequently, I think their concern is that this is now becoming large enough that it could be a systemic problem if it were to go into a distress element. And what might cause that distress? It's very sensitive because of the amount of debt to changes in the interest rate environment. And the way that things are going, if you look at the sort of geopolitical world, what might happen with interest rates, as I say, no one's got a crystal ball here, but business confidence is fragile as it is, whether that's in the UK, across Europe, in the United States. And we speak to people who are in all those geographies. And if there is a move to tamper down future inflation, or whether it's the war in Iran or whatever it is, I think these funds will come under quite a lot of pressure because of the additional costs that they're going to have. One of the things that we do look at quite a lot is they are now drawing on something called the PIK interest. So that's the payment in kind, which effectively extends the loans. It's extend and pretend to all intents and purposes. But if you look at some of these funds now, they're at like 8 to 12% of their loan books drawing on these facilities. And for me, that's quite concerning that you've got that many ostensibly good and well-diversified businesses, but yet they're all drawing on this. And the other issue is when these funds get marked down, they get marked down, not gradually, but very, very quickly from, whatever it is, their A grades, A minuses, to literally it's fully impaired. And we've seen examples of that. I think one of the more unhelpful comments, but it's a fair comment, is there's been talk about cockroaches, and that's manifested from the market finance solutions, some of the ones over in US, Tricolor, etc. This is now on everyone's radar, and they're concerned that if there's been fraud going on with some of these, which is proven fraud, could that also be going on elsewhere? And as I say, there will absolutely be very good operators out there, and it is a good way for investors to get a return if they've got, a good asset manager, the risks are well allocated, and there's diversification in there. But it's very opaque also. So there's a huge element of blind trust in this, that you have to be confident that your asset manager will do all of those things, because you will unlikely have access to that kind of information.
From lumpy assets to cockroaches, it's sounding rather grim. But from your experience, what are the most common types of fraud and governance failures that emerge in private credit transactions?
So as I say, I can speak from the property work that we do. And we have dealt with loans that have come through some of these funds. There have been fraudulent actors who sit underneath that, whether they are, and I can think of one in particular where it was about a £15 million loan. They had refinanced another lender. It was a development project that was stalled. There was lots of pre-agreed sales which hadn't been fully considered. But when you went and spoke to the individuals who were dealing with this loan, they were clever guys. They Goldman Sachs background, Oxford and Cambridge, absolute whiz kids when it came to understanding how all of this stuff worked on a spreadsheet. And it does. But what they hadn't done is they hadn't seen the asset. And this is the first rule of property. And, my old boss used to say to me all the time, you can't manage a property from your desk. You've got to go and see it, feel it, meet the people that are involved. And I sense that that isn't really fully appreciated or understood. And what happens with that then is it opens it up to fraudulent components. I was at MIPIM earlier this year, which is the big property conference in south of France. And I got to speak to a lot of lenders. And one of the things, a very consistent theme that they came out with was, the use of AI when it came to qualifying the quality of their various loans, how it was replacing staff in some instances. And indeed, some of these new businesses, they were actually almost wholly reliant on AI to do all of their credit underwriting, to do the facility documentation. And then, the person really only gets involved at the very, very end of the loan. And for me, I think that is incredibly risky. And I'll tell you why, because I discussed that then with another very senior bank manager. And what he said to me is, Rory, we have loans that come across our desk and we wonder why they've come to us, because they're so good. The proposals are absolutely excellent. There's nothing wrong with it. But it's that intuition that you have as a person that makes you think, what am I not being told here? And the computer can't yet do that. So when they are wholly reliant on this to drive costs and efficiencies and, the private credit, that's music to their ears when they try and get involved in these kinds of businesses. What it's doing is eroding that credit stewardship. It's eroding the care and attention that goes into qualifying some of these borrowers and loans. And I think that's quite worrying. And that opens it up then to potential fraud. As I say, there's been significant elements of that. MFS with the double pledging. I think there are other professionals that are involved in this as well, outside of just the lender. I think there needs to be very careful thought, even from my own professional body, the Royal Institution Chartered Surveyors, the accountants that are involved, the lawyers that are involved. These things don't happen in a moment, and about £900 million went missing on that one. So it's significant, and we'll see what happens when that all falls through.
Can't trust AI to trust its gut. In that respect, what practical steps can receivers and insolvency practitioners take to verify assets and identify potential issues early, helping to prevent similar problems from arising?
So I think it's basically going back to big core principles. Speaking from a property perspective, it's always start with the asset. So you need to understand what the physical asset comprises. And in traditional lending, they had a model which was Campari Ice. And that was basically, what's the character of the customer they're dealing with? So what's their track record? Do they have integrity? Have they got a good credit history? Then you consider their ability. So have they got a management team in place? Can they actually do what they're saying they're about to do before you advance this loan? Then you consider the means. How much equity are they putting in? What's their risk when they're doing it? And again, you don't have oversight of this when it goes into private credit. And then they consider the purpose of the loan. So you need a really clear understanding about what is that money going to be used for? Is it going to leak into other SPVs or different companies? Is it going to other sites? In our case, when we look at developments, that's what you need to be really clear of and be able to ring fence that money. And then does the amount that they're asking for correlate with what they're going to use it for? So if you are on a development project, have you got it back to back with a QS's advice to say that that's how much the works are going to cost? Have you reviewed the bill of quantities? Are you confident that, this all makes sense before the loan gets advanced? And then, of course, one thing that private credit does do is they think about repayment. So can the capital flows that come out of the loan then service it afterwards? They're very keen on that, but that's obviously standard lending practice. And it's things that when we look at a restructuring case, one of the first questions we always ask is, what's the interest rate that's being paid on this? Because we can't develop a restructure until we understand what level of debt service the property needs to be able to cover. So generally, it's going back to core principles. It's fundamentally understanding the asset, fundamentally understanding who the customer is, and making an assessment as to whether or not they have got integrity, whether you can work with them, whether there's things that have gone on there that need further investigation. But the real thing that helps in these situations is to intervene as early as possible. And this is sometimes lost when, these different distressed loans end up, banks become aware of them, or private credit funds, or whoever it is. They sit on it for too long. They try to work with the customer or give them extended payment terms to try and resolve these problems themselves. And sometimes don't have the full understanding. They're not attending the site. They don't really know what they're looking for. Some teams are able to do it, but in a lot of instances that I've seen, that hasn't been the case. And that uses very valuable time, because you've got a curve of decline and recovery, and it accelerates. The longer that you leave a problem, it becomes harder and harder and harder to make that better again. So that early intervention element is absolutely critical. And what we tend to do as a business generally is we do a pest pool analysis every quarter. So you're familiar with that?
Political, economic, social, technical, legal, environmental.
Exactly, yeah. So we do that every quarter to try and assess what the external environment looks like. We know we can't control that as a business, but why do we do it? We need to understand what the external business environment is doing so we can react to that. So we're always very cognizant of what's happening, which is why, as I've mentioned before, I'm looking at all of those early warning indicators. You look across, the United States at the moment, their personal borrowing's up about 40% on what it was at pre-COVID levels of just for regular people. Their credit card default rates are soaring at the moment. It's getting higher and higher. And that's before there's really been any sort of economic shocks, significant other than, probably fuel prices over there. So I think there are concerning headwinds. I can't predict that there's going to be an imminent recession or anything like that, but I think it would be remiss not to look at these warning signs and think how they might impact. And from a domestic point, what we're starting to see is much slower sales rates when it comes to the development projects that we're involved with. So again, that's because there isn't as much availability of credit. There's less appetite to buy some of these properties as well. And people are also concerned about catching a falling knife. They don't want to buy an asset that maybe in a couple of months they're losing money on. And it's funny because, you see a lot of people, they've been quite speculative. They're buying off-plan sales in Dubai. They're making, a couple of $100,000 without even seeing the thing built. And then they've lost all that money, and that has definitely caused issues now that we're starting to see. On one of the cases that we were on recently was a development project, and they had a lot of homes over in the southwest, second homes, and literally you go around some of these towns in Devon and almost the whole town is on the market. Very expensive now to maintain a second home, and you've got double council tax. People are feeling the pinch more generally, and it's a luxury item. They're starting to see those go, and they're the early warning indicators that we are very cognizant of and we sort of look at, because that helps us then give better advice to our clients. Because as I say, the earlier the better when you're coming into those things, but you can't learn all that information by reading it on the internet. You've got to literally go out there and see it and speak to people and understand that the challenges that they're having. So yeah, it's important really to sort of really get a grip of what's going on, use your own two eyes and listen and speak to people to understand what they think.
Boots on the ground, always. Over the last few years, it struck me that the government's been playing a lot of catch up in regards to situations like this. So how are recent regulatory developments shaping the private credit market? And what implications do they have for insolvency practitioners?
So it's a good question that I think there probably is going to be increased legislation. What there is at the moment certainly is increased oversight. And so as I mentioned before, the conversations that we've had with the Bank of England, they are definitely very, very aware of this. In order for them to sort of make meaningful interventions, they have to sort of be in a joined up process with the regulators, also with information from the insurance sector, which will be highly impacted by this as well. And then obviously legislation falls out of the back of that. In terms of insolvency practitioners, it's going back to the sort of core principles, making sure that you document the decision making that you're doing, making sure that you are exhausting all opportunities, and more often than not, if you are facing significant capital shortfalls on some of these loans, and as I say, I can speak from a property perspective and I see that happen on some of these loans, I think it requires a lot more of a creative approach, to think outside the box, to think about the art of the possible with some of these assets, whether that's to repurpose them, to maybe have staggered sales, look at lease regears, what can be done to stabilize assets before you take them to the market, because invariably at the point that you get them, they can be in quite a distressed state. So I think there's an opportunity within that for restructuring professionals. Certainly that's what we try to do, is to look at how we can add value to protect value and, treat the assets like that, because we are moving into a market, and I speak to peers around me that there are now more shortfalls when it comes to loan recoveries than there have been previously. And I think that's, again, an early warning indicator of tougher market conditions, more slack lending criteria that's gone into that, which has pushed up loan to values and makes it even tougher to get the full recoveries, and perhaps a more difficult lending environment generally. So yeah, it's a multitude of factors.
Looking ahead, how do you see the private credit market evolving over the next few years? And how should insolvency practitioners prepare for the challenges and opportunities that this may present?
So it's difficult to look ahead, obviously, because we don't have a magic ball. And I've said that a couple of times now. But if I look, and I wonder, how this will play out. And I take the time to go to these private credit conferences, which is unusual for a chart surveyor to do. But I'm really interested in it. And the reason I do that is because I want to understand this business model, better than our clients do. My thoughts in terms of how it could go is one of two ways, really. It will either be a slow death, if you will, or there will be a catalyst event which causes a significant implosion on this particular sector. So in terms of it, the slow death, it reminds me of a quote that Ernest Hemingway said, and he said, "Tell me how you went bankrupt." And said, "I did it in two stages. First stage was very slowly. The second stage was very suddenly." And the reason that I refer to that is you can see that happening in some of these private credit funds. They've grown very quickly. They promise double-digit returns. They have been able to offer those in some issues. But because of the contagion risk, because of some of the issues that have happened on some of these more fraudulent funds, And because of general market conditions not being quite as conducive and these cash flow projections not being quite as robust and good as they expected, they're not delivering the returns. What they're starting to do now is draw on the PIK, so the payment in kind interest. That is, again, delaying what's happening. And that is the it's happening slowly part of the quote. So you're starting to see, distress in there. It then will be marks on the grading of the actual debt. And I'd say that's when it hits hard and very suddenly. It happens and overnight you can be completely wiped out. As I say, I've got to say, there's good funds and there's bad funds, and then there's also the fraudulent funds. So I will not say that all of this will happen at the same time, and there will certainly be winners and losers. And, when I went to these various private credit conferences, one thing that was consistent is they were sure that when it came to the huge amount of investment in AI, which, attracts a lot of private credit investment. And from the property perspective, we look at the hyperscalers. So we're looking at the data centers and all that kind of stuff. They said there'll be winners and losers. And if they're saying that, they mean there's definitely going to be some losers. And the thing that strikes me about that as well is the huge amount of cash that is going into that sector. And when you have huge amounts of cash like that, and it is happening already, it is pushing up labor prices ridiculously to build these data centers. It's exponentially more expensive to actually deliver them. There's a shortage of labor that can actually do that. But also when you've got all this money, it gets wasted. It doesn't get spent efficiently because people, they spend what they've got. And a lot of these data centers that's supposed to be coming online in 27, 28, they're not. And that will impact the cash flows. And the impact of that is that they haven't been able to get through the planning system. And that wasn't expected when they did these fancy Excel models and they're trying to work out how all these cash flow projections will come in. So, and then obviously the final part of that sort of slow death is the gating. So that's when people are trying to get the money out and they restrict it to say 5%, or they're selling at significant distress values to try and move these assets back out. But at that point, people will really realize that they're not quite as diversified as they think, and that they are not dealing with liquid assets, which, is supposed to be understanding. The second bit is whether there's a sort of catalyst event, and that could be all the usual things that you would see. So, a significant spike in interest rates, global wars, geopolitics, all that kind of thing, what Donald Trump decides to say, all of those things can cause a significant issue. And the bit that's worrying with that is it may not be private credit that causes it, but it will be part of it, is how interconnected all of these different elements are. So when you think about the banking system, they're actually lending into the private credit area. So they say they're well capitalized, but then they're extending loans into that as well. So then the private credit guys are levered. So we used to refer to that as shadow banking. Obviously now it's terms of private credit. Then where the private credit firms have also started to get a lot of money is from the insurance companies, because it's regular. They can then provide back to them stable income returns. I used to sit on the housing association board, and I could never, over 3 years, could never get my head around why the pension liability got bigger and bigger and bigger. But we just only had to pay a little bit more every year. And it's going to be a huge issue at some point, but people are just kicking it down the road. And I think that could be exacerbated because the private credit industry has started to buy these insurance companies because they are so accretive and they generate so much cash that they can then use. So I think there is an interconnectedness. And then obviously with the general business environment as well, if there starts to be a run on these things and people can't get their assets out and people try to pull back, and we've seen it recently with HSBC at Barclays, they are saying they are not lending into those kind of vehicles anymore. The concern is then that starts to spread to other elements of the otherwise healthy economy and then damage that as well. So I think it's probably not big enough to be the cause, but it will be a big component part if anything like that happens. But who knows, we might be sat here in 5 years and it's all fine. My sense is that it will have its day because the underlying credit quality hasn't been fully understood or assessed in the way that it ordinarily is in normal lending parameters.
So, poor asset management, tech bubbles, and a disastrous war in the Middle East. I'll make sure to reset my calendar for 2007.
That was good.
If there's one piece of advice you and want our listeners to take away from today, what would that be?
Early intervention. So what I would say is whenever you are considering that, and I imagine the listeners for something like this are going to be the IPs, lenders, other receivers, or, insolvency practitioners, lawyers, We got into restructure to restructure. We are here to try and help, not just flog assets as cheaply as possible. And in order to do that, we need to be working very closely and collaboratively with our lender clients or the various financial institutions to try and prevent some of these things happening before they do. And for us as property professionals, where we can really help is assessing that asset quality, looking at the things that are on the ground, because it's a moving feast. Just because your valuation from 3 years ago says it's worth 10 million, that does not mean that it's worth that now, particularly on some of these assets that the value is very much entwined with the cash flows that it can throw off. And, for example, we're seeing that an awful lot in the purpose-built student accommodation sector at the moment. We're getting those coming through. And as I say, the main piece of advice would be intervene early. If it's property, it's a hard asset. You need to go and see it. You need to meet the people and act as early as possible. And that will be the best way to provide some solutions.
And this one is strictly off the record, but when they do make the Big Short-esque film of this situation, who do you reckon you're going to be played by?
I have no idea. Absolutely no idea. Someone good looking.
Exactly. Well, Rory, thank you so much for sharing your insights with us today. It's been a fascinating discussion. I'm sure our listeners will find it incredibly valuable.
Amazing. Really enjoyed it. Thank you.
With thanks to Rory Dillon of Fletcher Bond. If you're listening to this, there's a good chance you're preparing for the November 2026 JIEB exams. R3's examination support masterclasses are here to help you prepare with confidence. Learn practical exam techniques, tackle in-depth questions, sharpen your answer structure, and pick up real-world tips from recent JIEB passes and experienced insolvency professionals. Sessions taking place in London and Manchester this September. Book your place via the R3 website